Good afternoon, everybody. It is Friday, April 22nd, and by every measure, this was an absolutely ugly day for the markets. You had the S&P down over 100 points. You had the Dow down close to 1,000. This basically is putting us back to retest those lows that we had in early March. If you've been watching these videos a couple weeks ago after we had a really strong rally off those March lows, the question I was answering is this rally for real? Are the lows going to be retested? And the answer, of course, is, as always, we don't know. You don't know what the future is going to bring. But there was not necessarily the depth, and there weren't as many positive internal indicators in that rally that, to me anyway, suggested that we're done. And it appears we're not. I think we're getting real close to those lows that we had back in the beginning of March. Dow's still about 1,000 points above those lows. S&P 500 is about 100 points above those lows. But we're sitting now down about 11% this year for the S&P 500. Nasdaq's down about 19% or so far this year. And today's move to the downside on a Friday was the biggest move that we've seen since October of 2020. And 2021 was pretty good, so one day does not a trend make. But if you're looking at the news tonight, looking at what these markets have done, definitely not a fun day to be an investor. Bonds at least sort of held steady. They didn't really move. But again, we've had a really tough start this year, the bond market. I've discussed that in other videos. The Barclays Aggregate Bond Index, think of that as the S&P 500, high quality U.S. investment grade fixed income. It's down about 9% this year. I mean, it's one of the worst starts in the bond market that we've had ever. And it really comes down to Fed policy, inflation, of course, with the backdrop of everything that's happening in Ukraine. But let's just talk about the Fed, because I think that was the real driver today. The Fed's trying to get control of the inflation that's in the system without inducing a recession. I think they're going to be pretty hard pressed to do that, because the inflation that we see in the system right now is going to impact demand. It just definitely will. I mean, even in terms of buying a house, we've seen 30-year mortgage rates go from about 3.1% in January up to about 5% now. It's only April. These are really big moves for markets like that. And the Fed, they cannot increase supply, but they can kill demand. When they increase interest rates, they do kill demand. When demand gets killed, that becomes kind of deflationary. They've also said that they're looking at unwinding some of their balance sheet. So really, since the Great Recession, but particularly since COVID, when the Fed goes out and buys assets, they go out and buy bonds. They do it with money that never existed before. It puts money in the system. Now they're looking at possibly unwinding that, which pulls money out of the system, again, to try to get some of this inflation under control. You've got a couple things happening here. The Fed, I think, since the Great Recession, did a pretty good job of managing the currency. Did a little QE when they needed to, raised rates a little bit, and they usually pushed it a little too far. We saw that in 2018, market would correct, but they kind of were able to get that sort of balance. They're going to have a harder time threading that needle now, because you have not only what the Fed has done, really aggressive policy measures, but you're also seeing what we've had out of Washington, D.C., not just under Joe Biden, but also under Donald Trump, by the way. We had these massive COVID stimulus packages that were getting blown into an economic system where the supply of everything was radically reduced because of COVID. So you've got all these dollars chasing a lot fewer goods. So what are the bright spots on the horizon? You know, right now, obviously really uncomfortable, but at some point, you know, recession is probably coming. And I say that surely with not any great happiness about that. But normally what you see is the equity markets are going to respond to the recession before the recession actually happens. And when we're in recession, by that point, the equity markets have sort of moved on, and they've and they're pricing in now what the new reality is. But, you know, that's probably coming. Whether it happens this year, I think there's still a lot of enormous pent-up demand, maybe, but some point next year, it's a part of natural economic cycles. You get recessions. I think what the Fed has proven historically is when they start getting in these tightening regimes that they're in right now, they tend to push it until they break it a little bit. And then again, it sounds dramatic, but they do. They push it a little bit too far. System breaks down a little bit. Now at least they've got some powder that they can throw back at it in terms of lowering rates. And I think that's probably what you're going to see here. They've indicated a 50 basis point rate hike in May. I'm sure that they're going to be doing that. They've talked about maybe 11, maybe 12 rate hikes over the next couple of years. You know, I think that's a lot. I think they do that. They're going to invert this yield curve for sure. They're going to push short-term rates above longer-term rates. And we're already in an interest rate environment. We've talked about this also in past videos, where our interest rates, what we are paying investors in the United States, is higher than what pretty much anywhere else in the world is paying. So you've got higher rates already. They're going to try to push them higher. I think they're probably going to push it too far. But it's definitely going to suck some of the inflation out of the system. Are we going to get back to the days of 2%, 1.5%, 2% inflation? I don't think that's going to happen anytime soon, but maybe we normalize it like a 3 to 5. And I think you're going to see these inflation rates start to normalize toward the end of the year, because again, a couple things happening. You got the Fed starting to act pretty aggressively, going the other way. No massive big stimulus packages that are at least going to come out of Washington for sure through the midterms. It's just not going to happen. You got savings that people had accumulated. I mean, there was an enormous amount of savings that were accumulated during COVID because people just weren't doing anything. That's getting eaten through now, and so people have chosen to stay out of the workforce are going to have to go back and enter the workforce now. In terms of wage pressures, that's going to be deflationary for wage pressures. Supply chains are getting fixed. The profit motive eventually kicks in, and you're seeing now supply chain disruptions in a lot of different parts of the economy are starting to remedy themselves by higher prices that we're seeing. So, but in the meantime, this is really all about the Fed. It's all about, obviously, supply chain issues, which I think that piece is really diminishing. It looks like COVID, at least for us, mostly in the rearview mirror, not so much in China. Now we're seeing what the zero COVID policy is doing over there. It's been an absolute disaster, but a lot of that stuff is real positive. But it's also happening, of course, with the backdrop of Russia and Ukraine. So it's a lot of uncertainty, but right now this is all about the Fed, at least in the last week or so. So I just wanted to share some thoughts with you. I know I covered a lot of things, but just to summarize the 6 minutes or so you spent with me really quickly, today was all about Fed comments. We've known they're going to be hawkish. They've really reiterated that, particularly today. They're talking about a lot of rate hikes. We're going to probably get 50 basis points in May. I don't know that's necessarily the worst thing. I just hope that the Fed, again, does not bring a gun to a knife fight, that they are measured, realizing that just like a lot of these inflationary pressures showed up several months, if not in some cases a year plus, after these massive, incredible efforts that the Fed put in to stabilize the economy in the early days of COVID, the results of what they're doing today will also take time to show up. And so I'm hoping they don't push that a little too hard. They've done a great track record of not pushing it too hard. They probably will in this case. But at least now, I think we've got a lot of this price in the equity markets, and I think once we get through the cycle, we'll move forward from there. But that's what's happening. That's why we're seeing so much volatility. It's not just Russia, Ukraine, COVID. Fortunately, mostly in the rearview mirror. This is all the Fed. So, if you stay with me for 7 minutes, thank you, and until next time, bye.